What's up, folks? Welcome back to the channel. So today I actually want to talk about index fund investing, and this is very relevant, especially in a down market like this where we're setting new lows. And I want to take case in points of about 4 or 5 index funds that I think anyone should have in a diversified portfolio. These happen to be funds that I have in my own 401k, and I want to just go over the performance over the last 10 years to hopefully offer some encouragement that investing is a long-term game. And over time, the returns are not only going to even out, but you're going to be well ahead of the game. And I'm a big believer in that. And I also do talk about options and things like that. And I only ever mean those to be a small portion of your overall portfolio. I never believe in betting the whole farm or the whole house against, betting against the whole house. Like I believe majority, and that's what I am, majority index investor. And so what I've taken here, I've taken about 5 key funds, and I hold these in my own 401k, and I don't mention the names of who they're from because it's my employer, and I'm not going to get into that. But most companies, like whether it's Fidelity, whether it's Invesco, JP Morgan, whoever it is, Vanguard, they all offer the same fund families. So for me, the first thing I did when I started my 401k, I got out of the target date fund because that's like the worst performing fund. It barely keeps up with like inflation, in all honesty. Some years it's done 8, 9, or 10% a year. But I quickly balanced into large cap growth fund, my company's common stock fund, large cap value fund, which I just rebalanced back into this year, an S&P 500 index fund, and then a small cap index fund. Now, I've found the small caps tend to underperform the large caps. The biggest juggernaut in terms of investments in an index fund I found is the large cap growth fund based on growth stocks. And you can see on the screen here, this large cap growth index fund, what the growth of 10,000 would be over the last 10 years. And you can see, according to this, you can see it would have grown to $63,000, which is 6.3x on a 10x scale, right? So 6.3 times your original money. And I ran some other calculations and stuff here. I determined these average. I took the returns for each year. So you can see this fund in 2012 did 15.31%. 2013, 33.4%. 2014 was back down at 13.08. 2015, 5.63, then 7.10, then 30.16 in 2017. Then it was down in 2018. And then this was the best, the past 3 years before 2022 was probably the best 3-year period that I've ever seen in terms of investing. This fund in particular did 36.39% in 2019, 38.6% during the Rona in 2020, which was phenomenal, and then 27.64 in 2021. And year to date, when I took this was actually up, but this is this I actually took this a couple months ago, so we're definitely down in this fund. So I might have even taken this at the end of last year because I've been planning to do this video for a while and finally getting to the point of knocking it out. Oh, this is year end as of December 31st, 2021. And see, even the dog is fond of the funds here. But anyway, so that is really phenomenal in terms of index investing, and definitely does very well. And then if I look at the common stock fund, this goes back to 2017. It's done well, not as good as the first one I showed. 2.5x, and then an annualized rate of 14.8%. So these are tremendous returns that you can realize as an index investor. And the longer you go, the more money you get. Like if you max out your 401k, which I believe is like 20,500 this year, if you keep maxing that out and invest in these pool of funds, and especially this year, you're actually buying at a discount because everything, in my opinion, everything is eventually going to recover from where we are now. But this one, this common stock fund, it was almost up 25% in 17, down 9.25%. Then it was up 42.8% in 2019, which was its best year, to average out around 15%. And then as far as large cap value, this is one, and again, like I mentioned in the beginning of the video, you can get these with any firm, with any company, whether it's Vanguard, Invesco, JP Morgan, Goldman Sachs has their own funds, Fidelity. Like Vanguard has like the total world index funds, like the VTI, the VT, VTASX, I think. The 5-digit ones are usually the mutual funds, which I'm not a huge fan of. But in your 401k, like most of these are mutual funds, but being through a 401k, the expense ratio is not as high as a retail mutual fund would be. So that makes that better. But typically, I would rather have an ETF. When I index invest, I would rather have the ETF because I've never seen any evidence that a mutual fund outperforms an index fund. So this one, the large cap value, is actually up 3.55x over the trailing 10-year period of the last 10 years. And the best year, I'm not going to read every year of the 10-year period for each one. So last year did 25.16%. The highest year was 26.68%. Had a couple of down years. Best year was 32.5% in 2013. And the difference between value and growth, the value funds are more of your like dividend aristocrat stocks, like your AT&Ts, Verizons of the world, big companies like that. Like Procter and Gamble. In some cases, it might be, you might have an Amazon. Well, no, Amazon would be in the growth fund. That's why the growth fund did so well over the last 10 years, because it had like Amazon, Facebook, the FANG stocks, basically Facebook, Apple, Amazon, Netflix, and Google. As we see, those are starting to crash down now, which is, in a lot of people's opinion, is long overdue. But they had a good run. And then, in my opinion, the best diversification you can have domestically is S&P 500, right? 500 largest companies in the United States. And I'm a believer in, I could see adding, maybe an international fund. Like I've looked into like emerging markets and things like that. I think in 2017, emerging markets were one of the highest performing funds at like 38%. But they're very up and down, very volatile. And I feel that you get international diversification through US companies because we have so many multinational corporations here doing business all over the world. A lot of presence in China, India, all over the world. So I believe there's international diversification within the domestic S&P 500 companies. In this one, this was a 4.8x over 10 years. And I think seeing this is really helpful. And then, so total return, almost 172%, just adding these up cumulatively. And then, of course, dividing to get the averages. But this one did 32.43% in 2013. Its highest year, it was down in 2018, and then it came back 31.57% in 2019, and then 20 and 21, 28.73%. So in the last 10-year period, there were 3 years out of those 10 that it did over or close to 30%. Which is phenomenal. So those 3 years were probably a big portion of the gain, but we had other years where it was up 16%, 13%, 12%. Of course, in 2020, 18.45, which is still great. And then small caps, I've balanced in and out of small caps, and I'm not as big of a fan because these just can't seem to get their act together. The belief is that the small cap, of course, small in terms of market capitalization, that they will eventually outperform, and they'll grow faster because they're in those early growth stages in the product life cycle where you're starting out, where new products come to market and they're high revenue, but they can't quite get the expenses and the balance sheet under control. So a lot of times these companies lose money. Like you see, and a lot of big YouTubers pump these, like you've got the Smile Directs in some cases. And I'm not lumping these in because I'm not saying these are great stocks, but like you've got some of them like the Tattooed Chefs of the world, even the very garbage food company. So the idea behind these that I think appeals to most people is that you can get into these at a low price and that you're going to catch them early. But Those last two I mentioned haven't done so well. Smile Direct, I actually thought had a better chance, but that hasn't done well either. But the concept is the small cap thing. But small cap has done 3.55x over the last 10-year period, adding all of this together. And if you want to see this in more detail, you can always go back and pause and rewind, go in slow motion, and look at the screens. You don't have to only watch this one time. You can watch this multiple times, of course. And I can zoom in a little bit, but you see this one, the best year, 2013, and this is what got me hooked. The 39.07% return in 2013, almost 40%, phenomenal. So then, of course, the next year I get in, and then it does 5%. So you can't think that what something did last year is indicative of what it's going to do this year. And of course, the year after it was down, then it was up 21.5. And then it just really, so it had a decent year in 2019, but then, and it did 20% in 2020. Of course, everything ended up going up in 2020 with the amount of stimulus that the government pumped in to the market. But then last year it only did 14.9%. And I believe after like May or June, it was just dropping based on the Russell 2000, of course. But you would still have done well over a 10-year period. But really, I'm not as big of a fan of this, like I say, because yeah, it's had one or two good years, but it's very choppy and it just doesn't perform like the idea of small caps would suggest that it would perform. So that's where I'm coming from with that. So I think that it's important for any investor to have the bulk of their assets in index funds, broadly diversified index funds, which is what I do. I know I talk a lot of dividend investing and options, which I'm a big believer in, but that's a small portion of the overall portfolio. So, and you could, like I said, I'm not going to pick Fidelity or Vanguard. You can pick these types of funds with any firm. I don't want to be like, partial to any one particular firm. Every fund management firm offers like an S&P fund, a large cap fund, small cap, so on and so forth. But anyway, and there's my dividends. And then this is actually, yeah, this is a chart I put together, actually very interesting, just to show that broadly real estate and 401k and index funds are the biggest portion of my net worth, with the smaller portions, of course, being cash and checking, speculative, which is where I dump the options plays into, and things like that. And this is actually my performance over a 5-year period. House values are up. Of course, 401k has done phenomenally, crushed it. And these were as of the end of 2021. So these have been hit hard this year, obviously. Speculative positions were up almost 20%. The policy that I made a video on, the life insurance policy, is down almost 12%. Roth IRA not doing as well, but you see these things here. And then of course the top three, which, I kind of wish I was just in those top three funds in the 401k, and I did per year how these have done. And like I said, these two, like the large cap over the last few years, has just been crushing it. Divided by the last 5 years, I mean, look at that. That's like a 75% per year with this. Not sustainable, but during that 5-year period is pretty awesome. So yeah, with that being said, that's really what I wanted to cover. Long-term index investing should be at least a big component of your investing, in my opinion, in my edutainment opinion, my non-advice opinion. That's what I do. What I do has been successful, and I hope that was valuable. So if you like that, please remember to like, comment, and subscribe. And I'm going to try to, while I'm on vacation here, I'm going to try to have a video out every day, maybe sometimes 2 a day. I actually really enjoy doing this, and I want to do this full time one day. So thanks so much, and take care, and have a good evening.